On April 20th, 2020, oil didn't just crash, it broke reality. For the first time in history, the most valuable commodity on Earth went negative. Not cheap, not on sale, negative. Traders were literally paying people to take oil off their hands. And the reason why exposes a financial illusion most people still don't understand. Spring 2020. The world was locked inside its own living room. Planes were grounded on empty runways, highways turned silent, cities sounded less like economies and more like abandoned movie sets waiting for a crew that wasn't coming back. Global oil demand didn't slowly decline, it fell off a cliff. Nearly 30 million barrels a day vanished almost overnight. And oil? Oil doesn't respond to fear, press conferences, or good intentions. Wells kept pumping. Contracts kept settling, reality kept moving forward. Tankers drifted offshore with nowhere to unload, storage tanks filled to the brim, pipelines backed up. Cushing, Oklahoma, the physical delivery hub for U.S. crude, was quietly becoming a liquid traffic jam with no exit ramps. At the same time, millions of retail traders were stuck at home, bored, online, stimulus check confident, watching charts and buying oil ETFs like it was a clearance sale at Costco. Cheap oil felt obvious, logical, inevitable. What they didn't realize was that they weren't buying oil. They were buying exposure to a system under extreme physical stress, a market where delivery still mattered, even if most participants had never thought about it. They thought they were clicking into a trade. They were stepping onto a countdown timer, and it was already running. Let's rewind to the moment before everything broke. Oil was already falling. Headlines were already ugly. Traders were already nervous, but nothing looked impossible yet. This still felt like a normal crisis, the kind markets had survived before. Prices down, volatility up, everyone pretending they had a plan. Then, April contracts started expiring, and almost instantly the conversation changed, because this wasn't about price anymore, it was about delivery. Oil isn't a stock, it isn't a promise, it isn't a line of code, it's physical, heavy, relentless. If you hold a futures contract when it expires, you don't get a warning or a do-over, you get oil. Real barrels delivered to a very real place, Cushing, Oklahoma. That's where U.S. crude goes to die quietly inside steel tanks. And by mid-April, those tanks weren't tight, they weren't near capacity, they were full. No storage, no flexibility, no backup plan. At that exact moment, thousands of traders realized something they'd never had to think about before. They didn't own oil exposure, they owned an obligation they couldn't fulfill. And when nobody wants delivery and nobody has space, the price doesn't decline logically, it doesn't stabilize, it doesn't wait for consensus, it panics. What followed wasn't a normal sell-off. It was the market being forced to admit, in real time, how fragile the entire structure had become. And it was about to say it out loud. What pushed oil below zero wasn't panic, it wasn't stupidity, it was a rule everyone agreed to, right up until it started crushing them. This wasn't an accident. It was a traffic jam caused by people who thought they were just passing through. By 2020, oil trading had quietly stopped being about oil. It became about exposure. Paper barrels, synthetic positions, financial shortcuts that let you tap into price movement without ever touching the underlying reality. Click a button, get the chart, forget the rest. ETFs like USO turned crude oil into something that felt harmless, a video game asset. Buy the dip, hold the line, roll the contract forward, repeat. No smell, no storage, no responsibility. And for years that illusion worked, because someone else was dealing with the physical mess. But futures contracts don't care about convenience. They don't care about vibes, narratives, or what traders intended to own. As May contracts crept toward expiration, reality arrived with paperwork. If you didn't exit in time, you didn't lose money, you took delivery. And delivery meant Cushing, Oklahoma, already maxed out, overflowing, locked shut. No tanks, no flexibility, no last-minute solution. So everyone rushed for the door. Funds, banks, algorithms, retail traders who thought oil was just another ticker symbol with a cool macro story attached. Except this time, there was no door. The market flipped the script. Sellers didn't negotiate, they begged. Buyers didn't bargain, they disappeared. And price stopped measuring value, it started measuring desperation. That's when oil crossed zero. Not because it was worthless, but because nobody wanted to be the last one holding something physically existed with nowhere left to put it. And once oil went below zero, the damage was no longer contained. What broke next wasn't the price, it was the illusion of control. Once the price crossed zero, the market didn't pause, it unraveled. What began as a storage problem instantly mutated into a chain reaction. Funds dumped contracts at any price, not to make a point, but to survive. Algorithms followed without hesitation, doing exactly what they were designed to do: accelerate momentum, not question it. Speed replaced judgment. Producers watched in disbelief. Oil wells aren't apps you can close and reopen. Shutting them down takes time. Restarting them costs money. Sometimes it destroys the well entirely. So crude kept flowing into a system that had already decided it didn't want it. The warnings had been there for weeks. Inventories climbing, spreads compressing, liquidity thinning. But greed always speaks more confidently than caution, right up until it's proven wrong. First came denial. This will bounce, it's just volatility. Then came the scramble. Banks raised margin requirements overnight. Brokers changed rules mid-session. Risk departments panicked. Some traders couldn't even log in fast enough to respond. Screens froze while losses kept moving. What should have been a controlled drawdown turned into forced liquidation. Not because people made one catastrophic decision, but because thousands made the same safe trade, believing there would always be time to exit. The absurd part? Oil didn't vanish, cars still existed, energy demand didn't go to zero, but confidence did. And once confidence breaks, markets don't correct, they don't slow down, they cascade. The final minutes felt unreal. Prices were falling so fast they stopped making sense. Traders weren't watching charts anymore, they were watching the clock. Every second closer to expiration turned oil into an asset, into a threat. Then it happened. WTI printed negative $37 per barrel. Negative, not metaphorical, not adjusted, real trades, real money, real panic. In that moment, oil became something you paid to get rid of, like toxic waste with a Bloomberg ticker. Some laughed, the kind of laugh you make when your brain refuses to accept what your eyes are seeing. Others just stared, frozen, realizing the rules they trusted had quietly turned against them. It wasn't just a crash, it was the market admitting on live television that it had lost control. When the screen finally stopped flashing red, the damage wasn't over. It was just done spreading. The price recovered, charts stabilized, headlines moved on. To most people, it looked like the damage was temporary, just another absurd moment in a year full of them. It wasn't. Behind the scenes, the system quietly rewrote its rules. Risk models were adjusted, margin requirements hardened. Banks stopped advertising easy commodity exposure and began asking uncomfortable questions about who was actually qualified to trade physical linked products. Retail traders learned the hard way that oil wasn't a clean inflation hedge or a macro bet. It was a delivery-based market they had entered without understanding the consequences. Producers paid the real price. Small U.S. shale companies collapsed first. Bankruptcies surged. Wells were shut down permanently, not paused, not mothballed, but destroyed. Entire towns built around oil jobs felt the impact months later, long after prices had rebounded and traders had moved on to the next chart. And the lessons stuck. Markets became less patient. Liquidity vanished faster in later crises. When stress appeared, participants remembered April 2020 and ran earlier, harder, with less hesitation. The most brutal part? Nothing fundamental about oil had changed. Cars still needed fuel. Planes still needed energy. Demand eventually returned. What didn't return was trust. Trust in leverage. Trust in safe financial wrappers. Trust that someone else would always step in to absorb the risk. Negative oil didn't break the energy market. It revealed how quickly modern markets turn real-world assets into financial traps, and how fast those traps snap shut on anyone who mistakes price for value. April 20th, 2020 wasn't about oil. It was about what happens when financial systems drift too far from physical reality, and nobody notices until delivery day. Price lied. Liquidity vanished. Rules mattered more than beliefs. Oil didn't go negative because the world stopped needing energy. It went negative because too many people confused exposure with ownership. And that mistake isn't unique to oil. It shows up wherever leverage hides consequences, wherever convenience replaces understanding, wherever people assume the exit will always be open. Next time you see an asset on sale, ask yourself a better question. What happens if I'm forced to hold it? Because April 2020 proved one thing very clearly. In modern markets, the most dangerous moment isn't the crash, it's expiration. If you enjoyed this video, hit like and subscribe for more cool stuff they don't teach you at school.